Good afternoon, and thank you for joining the Future of Finance. Today's discussion is on programmable money. I shall now hand you over to Dominic Hobson and the panel. Thank you.
Hello everybody, I'm Dominic Hobson, co-founder of Future of Finance. Welcome to our webinar on what programmable money can do for us and to us. I don't know about you, but I've found programmable money much easier to understand at a very high level than at a very low level. It often seems to be much more about how we pay than what we actually pay with. In other words, more about payments than money. Programmable money also needs data. So maybe it's not about payments or money at all, just another facet of that most important trend in technology altogether, which is data. Meanwhile, we've got lawyers and regulators all struggling to decide what marks the difference between money, instruments of payment, investments, securities, and tokens. So I found it hard to avoid the feeling that in this digitized world, these fine-grained definitions aren't really making much sense. Where does money end and payment begin, and where does payment end and data begin? In fact, what is money in a digitized economy, let alone programmable money? Perhaps we need new, more and better terms than tokens and smart contracts to describe what's actually going on. Perhaps we need a whole new language to hold these realities in our minds. And to help us learn to speak that language, I'm joined by four people who approach this question of programmable money from four very distinct perspectives. Loretta Joseph is a former investment banker, an OECD official turned fintech advisor and policy influencer, currently based in Mauritius. Martin Walker is a computer scientist who's worked at a number of leading investment banks, specializing in repo and stock loan. Now head of product, securities finance and collateral management at Broadridge, Martin writes regularly about fintech and cryptocurrencies. Dr. Sean Steen Smith is an assistant professor specializing in accounting, economics, and business at Lehman College, an independent college of the City University of New York, and founder of the Institute for Blockchain and Crypto Asset Research. Simon Gleason is a partner at Clifford Chance, specializing in banking and financial markets, an advisor to governments and regulators, as well as banks, a global leader in the development of law and policy in finance, and author of the excellent legal concept of money, which I would urge everybody listening to this webinar to read as a fascinating primer and guide to the principles and ideas which underlie our topic of discussion today. In addition to our panelists, we also have you, of course, our audience, and all five of us, as always, encourage everybody watching or listening to submit questions and comments throughout this webinar using the Q&A or chat functionality at the bottom of your screens. Rest assured, we won't save them up to the end in the usual fashion, but we'll answer them as we go along. Now, we've got a lot to talk about, so I'd like to begin by addressing the problem I raised right at the outset, and that is the problem of definition. What is programmable money? Simon, you're a lawyer. You're probably much better at definitions and insist on definitions most of the time in your daily work, unlike the rest of us. What is programmable money in your estimation?
Okay. Well, the starting point is that there's no such thing as money. When I talk about receiving payment, what I mean is being put in a position where I can transfer value to somebody else. You think about it, you are utterly indifferent as to whether somebody gives you a £10 note or credits your bank account with £10. And the point there is, although we think of £10 notes as money and therefore think of money as a thing, actually that is just a coincidence. Money is a unit of account. And really what we're talking about here are mechanisms that have the effect of transferring value from one person to another. And what we mean by value, as I say, is the ability to transfer value to somebody else in turn. Now, there is no magic to the idea of paying debts. Everybody who's ever traded in their car for a new car has used the transfer of a physical object to discharge a debt. So strangely, there's no legal magic to money in that regard, except to the extent that money is the default setting. The idea of money, the idea of value, is what you use to appraise what you're about to do. And so the real question here is, how do we use these things to transfer value from one person to another?
So, Martin, you've just heard what Simon said. There's no such thing as money. It's whatever we regard, whatever we're willing to accept in payment, if you like. It's a value transfer mechanism. Is programmable money therefore not about money at all? It's about payment.
Oh.
You're on mute, Martin. Easily done. I do it all the time.
Sorry, someone had to do it. Someone had to be on mute first.
Me, don't worry.
Yeah, the thing I find fascinating about all the excitement about programmable money, which has kind of grown out of the blockchain space, is that most money's electronic and has been for decades. And it's been programmatically controlled and manipulated in various ways, from direct debits to the most complicated financial derivatives, which STP through to the cash flows, again, for decades. I think the two interesting things related to what people call programmable money, which are actually more than just that, are the concept you have of smart contracts in relation to cryptocurrencies, because that really is a new thing, because it's not really like any other form of existing money. And also the opportunities opened up by open banking and APIs, where there's the potential to allow people other than your bank to actually do things, to actually lock up or control or do things with your money.
I must ask you this, Simon, before we ask Sean to comment on this. Are smart contracts actually contracts, Simon?
No. I mean, what a smart contract is a set of protocols that apply in particular circumstances. It was actually a terrible error to call them smart contracts, because they're real things. They're just not contracts in a sense that a lawyer would recognize the term.
Okay.
Executing code.
Yes.
So,
Easy.
Sean, you've heard what Simon and Martin have said about what programmable money is. Is it just what I'm beginning to hear? It's just a form of conditional payment. You can, a payment will occur when something happens, an event happens.
Yes,
Is that
and to
working definition.
And to add on to the excellent terminology definitions outlined by Simon and Martin, what I would add here is that honestly, this whole conversation around can we program, can we direct, can we add certain conditions to transactions that are happening, basically, is a natural outgrowth, right? From gold to paper-backed currencies, credit cards, PayPal, Apple Pay, Bitcoin, Ether, all of these new ways of trying to, in essence, just try to trade value between the purchaser and the producer, or the buyer, seller. That's all that we're talking about. Now, this whole conversation, and it could be Bitcoin, it could be DeFi, which I know is a hot topic, and all that we're adding now on top of our current payment rails, right? Be it commercial banks, central banks, any type of financial or banking institution. Now it's basically being wrapped up in a additional way to either grant access, give access, direct the payments, or to add, probably the best way to do it from a CPA background, to add other internal controls on how the funds are spent, who they get, and then what external conditions or obligations have to be met prior to the transfer of funds or transfer of consideration is actually complete.
Now, Loretta, I've got two questions for you, which arise out of what Martin and Sean have said. The first is, listening to Martin, I thought, well, actually, do we need these programmable money to be issued onto blockchains at all? Couldn't we just have open banking APIs on a traditional infrastructure and achieve much the same effect? So do we actually need this, assuming that banks wouldn't obstruct it, as they appear to be doing with open banking? But let's put that to one side. Could we not achieve the same effect with APIs on traditional infrastructure? Secondly, listening to Sean, that if one of the defining characteristics of programmable money, in other words, the smart contracts almost define what programmable money is. So you get these specified usages. You can only use this money to buy food or redeem your mortgage or export some goods, or only this person can redeem this for fiat currency, or the maximum payment is $50 or whatever it is. In other words, it's not going to be fungible, this money, is it? It's not going to be like normal currencies. We seem to have lost Loretta. Has she disappeared? I don't know. Anyway, perhaps you could pick this up for me, Martin, because I think we've lost Loretta temporarily. I hope she'll be back soon.
Well, it's not, from my perspective, where you're adding conditionality to things, it's not so much fungibility. the big issue you get into is liquidity.
Mm-hmm.
So, there's people have this perception there's money in a bank account. Money. Most of what we see as money is a double entry concept, whether it's in a central bank reserve or it's in a commercial bank account. There's a set of assets and there's a set of liabilities. And one of the key things any kind of bank or even any corporation has to do is actually manage its liquidity in terms of actually having liquid assets that you can pay your obligations with. One of the big issues with this sort of the more blockchain crypto model one of the issues of locking up money and having a conditionality around it in too many circumstances, you run into liquidity problems because you basically have to fund. I have to lock up this lump of money. I have to fund this. And that's kind of really counter to the way most of the world of finance actually works today.
And I expect you're nodding, Simon, because what Martin is saying is that actually whatever programmable money is, it's not a bank deposit.
Absolutely. And I mean, the curiosity is, if you look at how these coins are potentially going to be used by broad retail, which is an interesting mental model. Broad retail has two options. One of them is you actually operate the coins yourself. That is irritating and difficult. And if somebody provides you with that service, you know what they're going to charge you money for it. Alternatively, you can use it like a bank deposit. You can say to your bank, I will give you these coins. You, bank, may now use them yourself, lend them out to other people, do whatever. And suddenly, instead of my paying the bank for administering my coins, the bank is paying me for the use of my coins. Now, it seems to me to be an absolute racing certainty that that is what is going to happen. And I say broad retail because that's the area where it's most likely to happen. I cannot imagine a retail investor paying a wallet provider to provide a service where he could effectively be paid by a bank for providing the service. And you may say the two positions are radically different because in the one case, the investor takes on the credit risk of a bank, whereas in the other, he has no such risk. But one of the things we've learned over many hundred years of bank crises is that investors in reality seem to be totally insensitive to that risk. And the fact that one service is free and the other service is charged for is likely to be likely to be determinative. So one can see these things being immensely useful for the sorts of thing Martin was talking about. Capital markets transactions that require rapid settlement, immediate triggering of payments and responses to payments and things like that. But in many respects, the idea of conditioning a coin such that it can only be used for certain purposes is actually the very thing that makes it unhelpful in a wider environment where it doesn't look as if they're going to be used anyway.
Uh-huh.
What kind of coins particularly are you thinking of, Simon? Because there's a whole spectrum now of what people mean by coins in the digital sense.
Well, I mean, all right. I think the world's simplest example. Every so often, people trot along to us with wonderful ideas for dealing with primary issuance of bonds, which at the moment takes about 48 hours.
Yeah.
And there are all sorts of project that we could get this down to half an hour, and the answer is you could certainly get the bond piece down to half an hour. It's the cash piece that takes 2 days. But huge amounts of certainly the stuff that I deal with, what we found is that automation of systems kind of works fine. It's the payment system that delays everything.
Yeah, and to sort of add onto those points, Simon, I do think that sort of what you're outlining is a trend currently underway here in the US, right? Where the OCC, the Office of the Comptroller of the Currency, has in 2021 alone granted 2 federal charters to have digital asset only financial institutions, because as we found out here with over the last few weeks, GameStop, options trading, all the rest, there is a fundamental disconnect between when a transaction happens and actually when the payment settles and actually clears, highlighting your exact points about who is the actual counterparty and how is that risk managed. And so to add onto that point, what I would argue, and in the conversations I've had with firms out there, policymakers, all the rest, is that there is this growing idea and this growing understanding that the idea of being able to program or direct or to try to guide money, funds, payments, it can sound like an abstract idea, but actually it is not, because, as you so accurately pointed out, individuals, right, the average person on the street is already handing over control and direction and custody of their assets, monies, instruments on a everyday basis anyway. So it's not really as wild a idea as it might seem, but it's important, I think, to always be able to break down and to understand what specific asset of the transfer of value is being talked about. Is it on the banking side? Is it on the payment side, or is it on the back office side?
We had a question from Hassan Eldahan, who says, why would digital coins earn less than fiat? What he means is why would digital coins pay more interest than fiat, not less?
Oh, you mean where they're actually they're based? You mean where they actually have the same value, like they're a stable coin?
Yeah, where they're, to borrow a phrase, fungible, I suppose. They're the same thing. One is a digital version of the dollar. One is a dollar.
Well, to some extent, you could reverse that question and ask, why doesn't the Federal Reserve pay interest on dollar bills? To which the answer is, it just bloody doesn't. I mean, one of the fascinating things about this aspect of this discussion, I think. We've got Loretta back again.
Hi, Loretta. Sorry we lost you there. Okay, but carry on, Simon.
So one of the fascinating things about this discussion is precisely the question of, when you first acquire your coin, never mind what sort of a coin it is for the time being, you probably do that by transferring real-world money to somebody. The question of who that somebody is and what they do with the money actually has some really big macroeconomic consequences. You know, at its absolute simplest, when you deposit money with a bank, what the bank does is lends it to someone else. It creates credit in the economy. If you gave that money to a central bank in exchange for CBDC, for example, that money would not go as credit into the real economy. It would go into the pockets of the government. And one way of looking at that is what you've created is the sort of Soviet Russian Gosbank model, whereby the government is the sole taker of deposits in the economy, and therefore, by definition, the sole creator of credit in the economy. Now, that may or may not be a good thing, but it's a pretty big consequence of something that starts off as a fairly minor thing.
I think that there's some fundamental implementation questions there which are completely independent of technology.
Yes.
So the idea of narrow banking has been around since at least the 1930s, and whether you have a narrow bank or not, that's an economic and regulatory question. Yes. Whether you have CBDC, where you could actually have restrictions on who could hold it, how much they could hold, whether you could have a cap, that's a separate thing. But people often muddle the two up. CBDC doesn't have to lead to narrow banking.
Let's bring Loretta. That's an important point. Listening to you, Martin, I'm thinking this. These programmable money could be a shortcut to 100% reserving or narrow banking, because if these are not bank deposits, these are just tokens representing value. You've got, by definition, a 100% reserving system. In your discussions with central banks, Loretta, and you're still on mute at the moment, so don't forget to unmute yourself.
I will.
Does this issue come up?
Yeah, and I think it's a very important issue, because I think you talked a bit about, Simon, about governments and central banks. Now, they're not together. I mean, and I think this is an interesting point where you look at CBDCs going, and over COVID, things like helicopter money in. Central banks at the moment don't have monetary policy to inflect in economies. Fiscal policy is probably at a minimum. Governments have to go through a whole lot of cabinet stuff. So if central banks can start deploying cash or money, and I lost everyone when I disappeared on my technological black hole. Money means something different to everybody. I mean, this is the thing. Money means it's a store of value to some people. It's a form of payment. But yes, I mean, it's a transfer of value. But money has really changed over the centuries. We started with, we exchanged potatoes and wheat, and then we moved to stones, and we moved to gold, and then we moved to a piece of paper that was backed by gold in 1973. Mr. Nixon got rid of that. So effectively, you've got paper that's not backed by anything. So yeah, it's an interesting place now. But do central banks start banking their people? It's a big question to me. I don't think that they should. There are certain instances in the world, if you look at the ECCB, where they're not going to have corresponding bank very soon. I think when the central bank needs to step in and start being banker, taking on the commercial banks, guys, I guess, to banking people, that is a very, it's a very small number of central banks. The majority of central banks shouldn't be doing this. I don't think that central banks should be taking over the mandate of the commercial banks. So it's bringing out a lot of questions about, where do we go from here? And I don't think central banks actually know, because they don't really, I mean, the technology as well. We talked a bit about fungibility, which I'm sure we'll have a nice discussion about in a minute. But yeah, I mean, there's a lot of concerns. There's deflationary and inflationary expectations when you got a token. There are so many questions that I don't actually have the answers to, and I don't think anybody does. So I don't think that this is going to be a question in the next 2 or 3 years. I think the Chinese think they're more advanced than they are, but let's see. But I think it's still very theoretical.
We've had a question from Peter Davey here, who says, I thought CBDC and smart contracts weren't overlapping at this stage. In other words, should a CBDC be programmable? Or should that be left to the private?
Yes. They're two separate concepts. You can have them overlapping depending on how you implement it technically, but they're two separate concepts.
But would we want the central bank programming money?
Not necessarily.
Depends why they're doing it.
I think I heard you say the Eastern Caribbean Central Bank is actually planning to run retail bank accounts. Is that right?
Correct. I mean, they're doing a pilot moment because they have
why,
a very.
Why wouldn't they program the money then?
They have a problem because they don't have any. They won't have any commercial banks. So when you start to have to bank your people, you've got to come up with a lot of new ways to do it. So if you don't have any commercial banks, you've got no choice. But most other central banks around the world have commercial banks, except in some of the other regions where we're starting to see corresponding bank disappear because of compliance issues at AML. So, it depends, but I don't think everybody should go down that route. I think central banks banking their people is not the mandate of a central bank. It's financial stability. But if that overlaps and you need to have financial stability, understand it. But most central banks don't need to be getting in the business of banking people directly. I think that's a dangerous road to go down.
Mm-hmm. And so I just add, every central bank that's involved in running an RTGS is actually involved in some kind of programmable control of money. And obviously on top of those RTGS, you often have a central securities depository. So central banks are heavily into that already.
We would not want, if we take the Chinese social credit system as an example, if the central bank controlled all the money, it could effectively exclude individual citizens from participating in the economy at all. You couldn't take a bus, couldn't take a train, couldn't go to the supermarket, because they would switch off your ability to pay for anything. And how real a threat is that, Sean?
Well, I mean, I think that sort of that outcome, both in China and elsewhere, is the ultimate fear, right, of this whole conversation on how do we program money, how do we get CBDCs to work, how do we get more of the currency and the transactions in an online format, right? Because if I'm doing transactions in a face-to-face physical fiat way, there is no monitoring of that individual transaction. But as we all talk about and we hone in on definitions, terminology, ideas, how it works from a IT side, how it works from a legal policy side, I would argue personally that there do have to be robust safeguards and controls in place during the build out, during the rollout, and then at certain intervals during it actually being used to help keep the government out of trying to now pick and choose what this currency or this way of doing business or trying to trade value can actually be used for, because then that opens up the whole question of, okay, fine, who is actually choosing what is correct, what is moral, right to be using this currency for? And I would argue personally, that's one of the risks that I know has been talked about, but I would argue that it's going to be one of the most difficult risks going forward, right? Because we have the tools, right? The blockchain works, automatic payments work, I can program money, all of the IT works, right? And banks are already doing it. Consumers are quite used to paying via their phone, via some sort of online format. But there is still this idea that the payment side and the banking side, or the oversight angle of it, are still two separate entities. And as these two become more intertwined, be it the form of a CBDC, a token, coin, blockchain, all the rest, there is going to have to be a clear and bright line drawn between who is in charge of the money, and then how that's actually used, or the process by which individuals and institutions can choose to deploy, allocate, use their actual funds.
I can't resist pointing out that actually we already have that mechanism today. If you look at the way money laundering legislation works, if you're designated as a money laundering person, you are locked out of the commercial banking system. And if you live somewhere like Sweden, where the cash business has gone, you are locked out of the finance. Can't get a bus.
That's a real risk.
It's a very real problem
Absolutely,
now.
it's a big risk.
We
don't want to
Martin, go ahead.
So just to agree with Simon, it is a very real problem now, because basically with the current laws around AML and KYC, basically all the risk is held by the bank. That means they veer towards to being more restrictive. So you literally do have the situations where in democratic nations with the rule of law, people cannot get a bank account and are closed out of the banking system.
Well, and a question on this from Hassan, actually. What are our thoughts about a private digital ID with KYC, AML, and CTF, counting the financing of terrorism? Do you think anyone other than banks and social platforms could perform this function? This fits quite nicely with our discussion about the CBDCs, because we can't really imagine central banks doing that KYC, AML, CFT work, can we? Whereas we can imagine the private banks doing it. Well, will they make a living?
There's a lot of providers that are actually starting to do this in the blockchain world. They're actually building protocols that give a sovereign self ID system, and I think they're important, because I think the biggest problem with databases at the moment, if you have governments, you have banks, you have central banks, you've got all these people that need to exchange information, and they don't trust each other. So that's the one time when a blockchain works. When do you need a blockchain? When you have parties in a network that don't trust each other but need to collaborate. So I think collaboration and competition, this is one very good example of when you have many different parties. Governments need to talk to each other, but they need to share information, but they don't like each other. Banks do, so there's a whole model for that. And I think that's I think that will be the thing that's solved in the next 2 years from blockchain. But we're just going back, and I was listening to Simon. My argument with central banks and programmable money, cash is the most decentralized thing we have. We can all hold cash. We can hold it on our bed if we want. We can put it in the bank. It's the last vestige, I think, of privacy that people have. And I think these systems need to work in tandem with what people want. So I think if people want to use mobile money, programmable money, that's good. If central bank's going to offer programmable money, that's good. But I still think people need to have the option to hold cash, because it's still very private. And that's what we were talking about, the unintended consequences. If central banks start to control money, and I have a 16-year-old daughter, do I want to see systems built now that can't be changed in 3-4 generations? No, because that is why people like the Chinese central bank are building these, not because of the blockchain being particularly great, but they know that they can control it, and it won't be a public blockchain, it'll be centralized. So these things, I think, are really important questions, and they're ethical questions that we all need to consider, and nobody has the answers.
Martin, could you just address for me the question Hassan is really asking, I suppose, which is what opportunities programmable money is going to create for the traditional banks? If we have a world in which we do have a CBDC and it is distributed by the traditional banking sector, but maybe they can't make as much money out of it as they used to. So what would they be doing? Will they be doing the KYC AML checks?
I actually do struggle to see what I can see some potential additional opportunities around some types of escrow arrangement.
Mhm.
But apart from that, if you're talking about capital markets, conventional banking and finance, and you look at the existing infrastructure, say in the Eurozone area, where you've got a whole variety of things which settle in central bank money already, whether it's securities or payments, I think the actual the number of scenarios is probably quite limited.
Well, one of his ideas is they should start manufacturing digital IDs. We're very keen on digital IDs at Future of Finance. We think they answer a lot of problems.
I think if you look at India, having a centralized national ID system actually does, whether you like it or not, does actually give a lot more scope to a central bank to actually issue cash. And I was reading a book, very interesting book, not published yet, but it was actually talking about how in Nigeria you can actually use your ID card as a prepaid credit card, because the key thing is you've been identified, and just actually having a central way of identifying you is actually really, well, it opens up some bad possibilities.
That's the key to money. It's identification, is ID. If you think about the crux of everything we're talking about with blockchain, it comes down to how you ID. And I think this is an important thing going forward. I don't think that that central banks will be challenged, but I do think there will be other means of people producing programmable money. I think if you looked at what Facebook did with Libra, technology companies can come out now and start to challenge central banks. And I think that's what central banks have been worried about. And that's why they weren't worried about CBDCs 3 years ago when I was telling them. When Facebook came out, Libra put everything front and center. And it brings up a whole load of questions about regulation, about decentralization, about globalization. So, these things are important. I think India and the central ID system only works to a point because it's been hacked. 900 million people had their IDs hacked. That's not optimal going forward. So you need these systems, and I think you will see hybrids now built of blockchains which have the security of the public blockchains like Bitcoin, but they have smaller amounts of players dealing in the blockchains because it's not necessary to have everything on a public blockchain. But I think the hybrid, the hybrid protocols that we're going to see developed, I think are going to be the most exciting, and probably where CBDCs and programmable money is going to have its next lift up.
So to just add a question that actually I just thought of here. If all of us are,
sort of ask them, Sean.
I know, but if the whole conversation is now towards a centralized, be it a blockchain or not, public-private partnership between how to create this whole digital ID and then having that be the access point or the gateway to actually get digital capital. I mean, how is it not going to end up with the actual central bank becoming actively involved in actually picking and choosing who gets access to what capital, if we're actually going down that route? It was more of a thought that I had.
So central banks could say this company is allowed to issue programmable money in effect to raise equity capital. That one is not. Which
effectively takes the central bank into business and commercial banking, which, by the way, is terrifyingly dangerous. Remember the reason Andrew Jackson closed down the second bank of the United States was precisely because he wanted control of its commercial lending policy. But just going back to your point about what's the use of this, I think one of the things that we tend to forget is that you've got to think about payments in two very distinct lumps. The much bigger lump is payments within a country. And that's sort of central bank dominated, RTGS based, and that's the area where you can see CBDCs just naturally slotting in. The other is payments across borders, so payments between countries. And the key point here is that money never leaves its home territory. If I want to make a dollar payment to somebody in London, you know what, I have to involve a US bank, and ultimately it has to go through the dollar clearing system. The real opportunity that the cryptocurrencies create is precisely the elimination of all the mechanism and gubbins that goes with the making of any cross-border payment. And I'd be inclined to argue that the continuing existence of SWIFT demonstrates that modernization in cross-border payments over the last 40 or 50 years has been absolutely non-existent. So what has been created there is a massive problem to which I can see smart money being potentially a useful solution.
I like that idea. Another desk play for correspondent banking.
Well, it depends on how you look at it. I've looked at multiple different models where they try to use cryptocurrencies in international payments. You still have the problem that at each end of the transaction, people want to have real money, which means you connect to the existing payments infrastructure at the destination and at the initiation. And I think governments and central banks are they do not like the idea that you just use technology as a form of regulatory arbitrage, which is what has been the case.
But what about CBDCs being settled directly between RTGS systems in different countries? Doesn't that get rid of the correspondent banks?
Well, if you're familiar with CLS, which is where most of the world's foreign exchange and payments ultimately settle, that's how it works. CLS is a multilateral netting system. It connects for all the major currencies in the world. It connects to the central banks. It nets off the payments. It's like a 1 or 2 day cycle, depending on how you do it. And it all settles in central bank money by connecting to the local RTGS.
All through Swift messages, I'm sure. Now, we've had a question
but I think
Martin Schmaltz read here. Before we leave the question of CBDCs, I think we should address this. He says debt money is subject to creation-destruction cycles, which mirrors the creation-destruction of goods and services in the economy. In other words, every deposit creates a loan and every redeemed loan destroys a deposit. What would be the impact of CBDC created at will and presumably destroyed at will? How would that affect price stability? And he goes on to explain what he means a bit, which is, do you believe that programmable CBDCs will be used to prevent the debt-based money system from gripping, in inverted commas, via forced spending measures like negative interest rates, i.e. forcing consumers to spend? So it becomes a programmable CBDC is a very powerful instrument in the hands of central banks as administrators of monetary policy. And so they can inflate and deflate the economy at will, which must be a very tempting idea for them. So Loretta, very quickly, do the central banks you talk to, are they very excited about CBDC as a means of directly inflating or deflating the economy without having to bother with all these tiresome commercial banks and creating commercial bank money in the middle?
So I think with the issue of what we're talking about there, yes. So monetary policies, to be in at the moment, what does the banks do? Monetary policies are negative. Fiscal, as I said before, fiscal policy, they have a bit of pull with, but I think the mandate then to be able to control this sort of stuff, it becomes very, very powerful. And to be able to at will move monetary policy when.
Are they thinking that? Are the central banks actually saying that to you, Loretta? Are they saying what's really attractive?
Yeah, well, I think the attraction is in how they can get money into people's wallets when they need to. I think, if you're looking at a lot of the emerging world, the problem was over the COVID, there were a lot of people that didn't have any money and they didn't have the ability to go through a commercial bank. So central banks have the ability though to put money into people's accounts. So I think that's a good analogy of where programmable money is used. I mean, I always use the example, if I could give somebody money to go and buy food, and that's all they could do with it, that's a very good outcome. So I think they're thinking about that as well, but I don't think that's the number one priority.
I mean, I can't help thinking. There's a very good paper by Manmohan Singh at the IMF came out a few weeks ago, just making the point that if there were any connection at all between the volume of money in circulation and inflation or growth, we would know all about it by now. The last 10 years have been a very public economic demonstration of the fact that quantitative monetary theory just does not work. And so to that extent, I'm inclined to say that it really doesn't matter.
So a so a
Oh,
Go ahead.
Sorry, Sean.
No, and so the only comment that I would have on that is that yes, it's the quantity or it's the actual volume of money. It's also the velocity of the money, meaning how is it being used, who is
Yes.
using it, all the rest. And as we've seen, wealth inequality also increased over the last 10, 15, 20 years. Higher income, higher earning, higher asset value individuals are not on average as inclined to actually go out there to actually deploy capital into the marketplace. So I would I would argue that it's not quite as cut and dry as it might seem at first, especially if we try to transition out of a fiat debt-based system into more of a programmable system.
Yeah.
Okay.
And I hate to just revert to textbook economics, but Sean is quite right. The Fisher's equation, it refers to the velocity of circulation as well. And we have actually seen the velocity of circulation of money significantly decline. And just to go back to one of the other points, economically, CBDC has the same characteristics as cash or central bank reserves, and it can be destroyed and created in exactly the same ways. It's exactly the same. It's just a liability on the balance sheet of the central bank.
Yeah.
Could we just, before we move on to some of these use cases, talk about the ICO bubble and the DeFi bubble, which I think is what's happening at the moment, whether these are discouraging precedents for programmable money? I noticed, Martin, one of your articles, you quoted the famous Bitcoin skeptic David Gerard saying that DeFi is a worked example of the hazards of programmable money: incomprehensible financial derivative instruments, bots front running everything a human does, hackers stealing everyone's money through badly written codes. Now, in any period of innovation, you're going to get lots of wasteful and fraudulent activity going on. But on balance, have we learned new technologies from ICO and DeFi, or are they just?
Having sort of drilled in a little bit to DeFi recently, the thing that strikes me is at the bottom of most of them, you're providing collateral in the form of one cryptocurrency, which is over collateralized. And the reason you don't have the liquidity problems that you would have if it was real world money is, frankly, it doesn't matter. There is no use for cryptocurrency other than just for over leveraged pyramid schemes. And ICO was just, there were some clever ideas in the original people about decentralized companies and decentralized organization, but fundamentally they all just turned into another form of regulatory arbitrage to get around the restrictions on issuing securities and investor protection.
Mm-hmm.
Having written ICO regulation, I have to agree on that, and so I mean, but I think regulation came into that market when there wasn't any in 2018, and everybody who said they were a utility was not a utility; they were a security. I'd even argue that Ethereum was a security. That bubble burst, and DeFi is just what they were calling back in 2018 open finance. But the problem I see with decentralized finance is that we as regulators, what do we regulate? We regulate intermediaries. But we've taken out the intermediaries, and this is peer-to-peer banking, essentially decentralized. So it begs the question, if you're trying to protect the consumer and the investor, but if they're doing it peer-to-peer, do we really need regulation? So these are questions that are coming up. The ICO regulation was a problem for me in 2018, and I had to think about what a security was, what a utility was, and what something in between was. But now DeFi has brought up a whole new regulatory questions about what are we regulating if there's no intermediaries we're regulating. I think that's going to be an interesting one.
Martin, you wanted to say?
This is what a friend of mine referred to as techno washing. It's where you create a layer of techno confusion over something. If you look at any ICO scheme, any DeFi, there is someone running it and someone making money out of it.
Well, see, what you do is you look for the beneficial owner, and exactly this. You get people and the scammers by who the beneficial owner of all these things were, and the ICO goes, they could get around that, but eventually we as regulators can't find ways to regulate. But the DeFi one is it's still sitting with me, it's problematic because we do regulate intermediaries. We can regulate banks and central banks and prudential regulators. So with this peer-to-peer banking, effectively, it's scammy. It's very scammy. And, and on ICO, they used to call people advisors, and advisors would get all these tokens. Now, they give governing tokens in DeFi. It's just same, but different. So, they've repackaged everything with the technology overhang, and, great references to food. And regulators are not good at things, but when you're calling projects about, the sushi train or the yam swap, and they're raising, ridiculous amounts of millions, regulators turn off because they think it's a joke. But this stuff is still problematic for, recourse. The protecting a consumer and investor always comes back to the regulator. Even when the DeFi guys don't like it, when they have a problem, they always look at who can, solve that. So I think it's going to be an interesting and very problematic for us regulators going forward.
Okay, I'd like to move on, and Peter Davies given us a good way of doing that. I'd just like to share something he says with you, Simon. He's about the correspondent banking thing, that currency never leaves the country. He's pointed out that actually US dollars do settle inside the Hong Kong Monetary Authority's RTGS system, and a sealed system doesn't leak into the USA. So it's not always the case.
But you know how that works. They have an account at JP Morgan.
Yeah.
In New York.
Yes.
Okay. All right.
Sorry to be so nerdy, but I've just found it fascinating when I first.
We love nerds at Future of Finance. Which we are a group of nerds ourselves, really. But he goes on to say, why are we focusing on CBDC when DeFi is focused in different areas? And that's a good segue into what really. And we've started to talk about DeFi now, but what is programmable money for? In the end, what's it for? What use cases, I suppose, are your favorites? Sean?
Sure. So what I would say now is that it's too early to actually point to too many tangible real world use cases for a coin token, be it a governing coin, be it a newly issued token linked to a DeFi project. MakerDAO, BlockFi, all these different entities out there are still really based around, as we've pointed out, really the on-ramps and the off-ramps to a large number of these projects, DeFi labeled or not, is the trading of fiat into crypto and then back into fiat at some point during the actual process. And so a interesting case that I'm starting to hear more about, and I do know it's an idea and concept that has been out there for a while, it's this idea of how do I tokenize real world assets? Basically, how do I bring together fiat economy and the crypto DeFi firms that are out there right now? And I would say that really, and there have been a few cases where there have been buildings tokenized, new developments tokenized. And so I would say personally, and it is not a perfect marriage between DeFi and fiat, but I would say being able to tokenize, and I do know that as you start to tokenize tangible physical assets, there are all sorts of questions linked to custody, provenance, who is actually in charge of the project, and so then what rights and obligations do these coin and token holders have? I would say personally, that's the area I am most amped about, trying to bring in this whole sort of DeFi crowdsourcing open finance model, and to try to apply that to large scale capital projects that would otherwise not be open to those individuals. And I'm fully aware that there's all sorts of investor safeguards that are going to ultimately have to be put into place. But I think that's where there could be a opportunity, again, if there's more dialogue between the entities out there and the policymakers up front, as opposed to just after the fact when things go sideways.
One of the things that made me think that programmable money is really about payments was that as I was reading around this, there was no shortage of ideas as to what conditions would be written into payments. So you'd link them to deliveries. Did you receive them? Were they the right amount? Were they the right quality? Was there a discount? You could make a payment condition on the provenance of the goods. For example, did this come from organic farmers in Peru? Or you could self-execute when you got the goods. You could link payments to the Internet of Things. For example, the fridge is empty, you order more beef to put in it, and there was one in the Bank of England paper where the VAT would be transferred immediately from the shopkeeper to HMRC at the very point of sale. There, you wouldn't be filling in your quarterly return anymore. You'd pay your energy bills by usage, not by being sent a bill once a month, or estimating or reading your meter or whatever. So, you could see this leaking into all sorts of areas, including what you touched on earlier, Sean, the capital raising. You could see it getting into trade finance with sensors on ships and so on. So it seems to be all about payment. But Martin, maybe you've got a list of use cases which don't come from the same sources as me.
No, that's all all these things fundamentally come down to conditionality. Most already dealt with in the existing world, whether it's delivery versus payment for securities, payment versus payment. Some of the things in trade finance, which are managed by banks, like letters of credit, it all comes down to conditionality. And even if you talk about, I can't remember if it was Lerter talking about it, but the examples about, if you give money and you restrict people to spend it on food or whatever, like food stamps in the US, you could do that programmatically, but it's just conditionality.
Okay, so Simon, what are the benefits that you see from programmable money? We've touched on some of these. We've talked about faster atomic settlement. We've talked about, one of our audience, talk about piercing the lower bound on interest rates. What do you see as the benefits of this?
Well, I think
you don't see any. I don't know.
We've got to make a clear distinction between systems that do things with money and doing something to the actual money itself. So I think we're talking about the second of those. Now, if you want a good mental model of programmable money, personally, I think checks aren't a bad place to start. For younger viewers, this was a mechanism your grandfathers used to make payments.
or Americans, Simon, they still love checks.
Americans to this day, good point. But
there's one here. We've got one here.
If I write a check to cash, uncross it, and put a card number on the back so it's accepted by the bank, what I've created is, if you like, as good as cash. It's as good as a £10 note issued by the bank, or whatever the denomination is. You look at what I can do with it, crossing it, making it payable to a named payee. Those are all restrictions. The reason I do those things is security. And to be perfectly honest, I think all forms of programming money have the effect of reducing its usefulness and therefore arguably reducing its value. Why would you do that? In order to increase your confidence, it will actually get to the person for whom it is intended and no one else. So I have a strong suspicion that a lot of this will come down to an electronic equivalent of crossing checks made out to a name bearer, just so that you can be more confident than you would otherwise have been that they're not going to get diverted along the way.
Hence its use in paying welfare payments directly,
yes,
or furloughed workers directly. That's one of its attractions.
Yes.
Now we're down to our last 10 minutes or so. So I'd like to talk a little bit. We talked about the benefits, and we've talked about some of the problems. But I'll also talk now about the sort of dystopian visions of how programmable money could unfold. And one of the benefits of cash is that nobody asks questions. If you go into a shop to pay with a £10 note, nobody asks whether you're gay or straight, black or white.
If you go and try to spend £5,000 or £10,000, then they start asking questions.
Yeah, they then say, "Where did you get that from?" And we're going to report you to the authorities as a suspicious transaction. But the reason that criminals, as well as people who are have other reasons to be concerned about their privacy, like cash, is it does not ask. It doesn't know the cash doesn't know anything about you. Now, that will not be the case with programmable money. Indeed, the whole point of programmable money is it knows a lot about you. It understands us, if you like, which is why I titled this, What Programmable Money Does to Us. Now, and we've touched upon China already, it can be used to reward good behavior and punish bad behavior. How worried should we be about the idea that the government, and we'll come on to what the private sector does with this information, but what about governments knowing too much about what we're doing and having too much control over our day-to-day economic activities? How real is that concern? And
I think it depends on the government. I mean, I've been to the HSBC service centre where they actually dealt with requests from the police about getting access to bank accounts. Most transactions are electronic. and well, you have to get a warrant in a country of the rule of law. If it's not a country of the rule of law, they're just going to get the information anyway. Physical cash does preserve some privacy and some freedom around the edges, but it really depends on which country you're talking about as much as anything.
But it's still a level of privacy, cash, and that's what Bitcoin is, and that's why Bitcoin was built, because the people that built Bitcoin were very concerned about their privacy. They don't particularly, the libertarians of the Bitcoin maximalists don't like governments, they don't like central banks, and they certainly, so that's one reason why Bitcoin was built, and its security, is a big factor in that, because I think there's a difference between privacy and secrecy, and I think that's two words that get very mushed up in cryptocurrency a lot. But the Bitcoin guys really cared about the security of their moving assets. So it's very slow, it's very clunky. Bitcoin was never built to be a payment system. It was built for its security, and it's proven as a database it's the most secure thing we've ever seen. So if we take that out of the realm of how Bitcoin, which is the digitalization of money, is created, and we give it to central banks to do the different, use the benefits of that, but to create something that they can start to control us and our children, I don't think that's a very good, the consequence out of this as well. So we have to really think about these things, and I don't think there's a right answer. But the ethics around these programmable money is very important. And I think there needs to be a lot more thought put into it, because technologists are not central banks or policy writers, and policy writers and central banks and regulators are not technologists. So we all have to come together from all parts of the stakeholders to make sure that what we're doing doesn't have unintended consequences.
And so the only comment that I would add there is that I think that all of us, be as individuals or institutions, have become accustomed to having our privacy and our information be able to be accessed by any number of external third parties.
Yeah.
Amazon, Uber, Netflix all know quite a bit, too much probably, about all of us. And so the real question is are we comfortable as a country, as a global finance system, to actually openly, grant that level of transparency and access to either a central bank or a central issuer of some sort of national ID? Are we comfortable doing that sort of upfront, as opposed to how all of us have become used to having it happen to us anyway, and honestly trying to not think about it too much? So it's more of a ethical question, more of a educational question, and honestly more of how do we put the policies in place, to a earlier point made, that if there are changes in a country and the world at large that are going to cause us to want to at some point later go in and change who has access to what, are we able to actually do that? Is there a process by which all of that can happen?
So Simon, do we want, Loretta used this ethics, do we want ethical money? Do we want money with a conscience? What if I'm an inveterate smoker and the only money I can get can't be spent on tobacco? Is that a society that you'd like to live in?
I feel highly confident it's not going to happen. If necessary, I will take the money and spend it on something else and hand the something else to the tobacconist in exchange for the cigarettes. But in terms of restrictions, you have to remember, as I said, we are there already. Government went to people 20 years ago and said, we want the power to have unprecedented access to the whole of your financial records and the power to go after people. And our explanation for this is we're going after terrorists and drug money people and launderers. That's all right, isn't it? And the vast majority of people in the vast majority of democracies said, yes, that's absolutely fine. It's the problem of, if what you find yourself trying to do is to protect the privacy of people over the protests of those people, then you have to accept that you might be you might be on a bit of a losing wicket.
And we've got literally a couple of minutes left. I'd just like to address points made by some of our our audience. There's a comment here from Ismailyov Ruslan, who says, recently the group of 7 recommended to modernize cross-border payments. What has happened in the international monetary world or in the financial system? G7 recommends the modernization of cross-border payments. International payments are not something new for financial systems. We've had international payments quite a long time ago. For example, SWIFT was created in 1973. Why now? Why did they not do it a long time ago? He's really asking, why do we still have SWIFT and correspondent banks, which seem to come up in virtually every webinar we have? Martin, I know you know the answer to this.
Oh, you want me to? Well, the people like to beat SWIFT, and they, especially from the cryptocurrency world. The reality is the SWIFT infrastructure has been developing for years. And it's not like it's stuck in some 50-year-old time warp when you actually used to have SWIFT terminals, etc. The other thing is people muddle up SWIFT, which is a messaging system, with the system of having corresponding bank accounts. And the thing about having corresponding bank accounts is it actually speeds up payments, because if you have corresponding bank accounts, you can have, and you keep deposits in them, you can make payments in minutes, which is one of the things you can actually do with many remittance firms now. There's a hell of a lot of mythology about how international payments work. There's obviously scope for improvement, and there are some areas where it's very expensive, especially things like using on the Visa or MasterCard network. But it's not it's not this dinosaur.
What's not mythological is that you do get these very long chains of correspondent banks. Sometimes it's not just one, but several chains, and each of those banks is taking a bite out of that payment.
It's true.
Intrinsically an expensive system, whatever role SWIFT is playing in it.
And the friction is people make
SWIFT
money.
is building a platform to make it cheaper.
It's true, but it's the nature of the correspondent banking relationship. And I did read a statistic. The average number of jumps is like 2.6. So there are some very long ones. And I think one of the things that's worrying, which is a step backwards, is because of the pressure on AML, etc. The number of corresponding bank relationships has actually declined enormously in recent years, which the net effect of that is you have more jumps. But that's not a feature of SWIFT or the messaging. That's a feature of just how the international banking system works, but also in response to regulation. I don't know what the answer is.
Now, just one last comment from Martin Schultz. Cheap money allows companies to roll over their debt. Going negative on interest rates is uncharted territory. I don't think it is, actually. It's happening, isn't it? The relationship between interest and inflation is direct, not inverted, since companies have to account for the price of money in their prices. That's more of a comment on what we've been saying than a question. We must stop now, but before we do, I'd just like to get a thought from each of you on how we think this is going to happen when it does. Are we going to get a small number of CBDCs, plus maybe a handful of private programmable monies, or are we going to get a host of programmable monies, this non-fungible currencies? Loretta, perhaps you could address that first. What's the future going to look like? Very few programmable currencies or lots of them?
I think there's only going to be a few. And I think central bank currencies are going to morph into being very different for different countries. I think we talked about cross-border payments. So I think there is a huge use case for wholesale central bank payments, because central banks trust each other to get, if you're looking across regions and trade financing. I think wholesale CBDCs is the thing that I actually find more exciting now that I'm sitting in the dark. I think retail CBDCs are going to be different across regions. I think you have to look not at the world as on a global scale, but how these work in different regions. Because to be quite frank, digital money and programmable money in places like India and Africa have been around for a hell of a lot longer and have been very much used by central banks in Africa, than they have in the Western world. So I think these economies are going to be the leading in devising different systems. But I don't think that we're going to see a lot of different firms with programmable money. I think what you'll see, though, with the blockchain is that protocols will start to morph, just like they did with the internet, and there'll be hardening of security systems, and these things will be just infrastructures. I don't think we'll be talking about different blockchains and different programmable money in essence of different in different companies and different protocols in the future. I think that's going to narrow down to a much smaller number.
Sean, a last word from you on lots or little.
Sure. So what I would just sort of point out that there are 8,000 different cryptocurrencies right now being traded, and that ultimately, I mean, we aren't going to end up with 8,000 different types of CBDCs, currency options out there being used. But I do think that it is going to ultimately end up, as was pointed out, on actually what it's being used for. Is it being used intra-country? Is it being used for international payments, or is it being treated like I would argue Bitcoin is, as a commodity investment hedge? And so it's ultimately going to come down to how it's being used, who is actually using it, and are there any externalities that are linked to being a part of that payment network. So to actually answer the actual question, lots now, fewer later, broken out by how they're going to be used and who is actually using them.
Yeah. Simon, the very last word of the entire webinar will come from you.
I mean, I think
the first word.
Okay, I think the things that exist are not money in any meaningful sense of the word. They're commodities, and they exist for investment purposes. If we focus on money, I think the future is going to be CBDCs. I think they will effectively be the replacements for the existing RTGS systems. I do not think they will have a retail presence at all. I think they will exist for purposes of settlement between banks, between financial institutions, and potentially in wholesale markets. But for my money, that's where we will end up in terms of money.
Thank you, Simon. That's a great note to end on, a very clear vision of the future. I'm afraid we must stop now. I'd like to thank our panelists, Loretta Joseph, Martin Walker, who had to leave. I know we had a hard stop at 3, Sean Steen-Smith, and Simon Gleeson from Clifford Chance. Our next webinar is on the 23rd of February, Tuesday the 23rd, that is, same time, sad to say, same place. And we'll be discussing the meaning of AI, machine learning, and robotic process automation in financial markets. We hope as many of you as possible join us then. But for now, it's goodbye from the 5 of us. Thank you also.
Thank you for joining us. You can find this discussion on www.futureoffinance.biz and indeed other planned webinars under current events. I am Wendy Gallagher. If you would like more information about how to work with us, please do email on wendy.gallagher@futureoffinance.biz. Thank you once again.